Rodney Richerson with KBS. I'm the regional president of the western half of the United States for the company. As one of the largest owners of commercial properties in the United States, KBS is really focused on the top 20 markets across the United States where we're seeing significant employment growth and tenant demand. We're seeing continued rent growth across almost all of these markets and declining vacancies across the 20 different markets that we're actively acquiring assets in. Driven by corporate America's necessity to attract and retain talents, we're really focused on acquiring assets that are very well located in either CBD locations or what we consider urban nodes, which are a little bit more suburban, but they have very walkable amenities. They'll have multifamily, great retail access, and where available in different cities, access to light rail, metro subways. I think with tenants needs to hire and retain great talent, it's very important to be located in these types of communities. The other important component of when we're looking to acquire real estate is a focus on assets that have great universities nearby that really provide these tenants a pipeline of high quality tenants year in and year out. We really focus on acquiring best in class assets in these markets. And really one of the things we do, whether we acquire it already done, if not, we actually implement this throughout our portfolio, is building out really great amenities for our tenant base. We believe that this actually helps attract and retain employees for our tenancy. And we're really focused on high quality amenities such as outdoor lounges, fitness centers, indoor lounges, very large conference facilities that can accommodate 40 to 70 different people, which allows tenants to actually use our buildings rather than go off-site into third-party conference facilities or hotels. At this late point in the economic cycle, we're starting to see a lot of lenders go a bit risk off in terms of lending for new development. So we're seeing actually a reduction now in new office development, speculative office development across the country, even though we continue to see strong tenant demand in most of the markets we've invested in. So we believe that this actually is providing a great economic opportunity for office owners, where you continue to have strong tenant demand, but also a declining pipeline of new construction. For example, we've renewed two of our largest tenants across the portfolio, Union Bank at the Union Bank Plaza in downtown LA, and one of the largest leases we've done in the company history was the renewal of Anadarko in downtown Denver. Downtown Denver, we actually competed with a new development that had actually started construction. They were pretty far along with this building in negotiations, but our commitment to invest significant capital in the building, adding the amenities, outdoor lounge, conference facilities, and fitness, we were able to convince Anadarko that this is going to be a great long-term option for them. So, you know, with a complete restack of their offices, we're looking at about a 20% efficiency of Anadarko's space needs. So, with new construction, a little bit more open floor plan, they're actually seeing about a 20% saving in office space. Tenants of all generations, not just the millennials, are really looking for work environments that provide that live, work, play environment where you know, you can actually walk from your apartment. Again, if you have light rail accessibility, that's where a lot of people actually want to live in, or more of an urban environment. So you really have to be able to provide light rail connectivity. It's something tenants are really focused on. And really most importantly is walkability of retail amenities. They want the ability to walk to a grocery store, to walk to restaurants and bars and coffee shops and other retail type amenities. But we think that's a very important component to attracting and retaining our tenants within the portfolio. Our Accenture Tower asset in downtown Chicago is a perfect example of these amenities that we're really focused on. The building is actually located on the Ogilvy train station, providing the building some of the best connectivity throughout the city. It also includes 80,000 square feet of support retail at the train station, which includes convenience stores, restaurants, bars, coffee shops, and other retail amenities for our tenant base. And in Chicago, with very difficult winters, the ability to not have to leave your building to go eat, to go have a drink, or just get back on the train and go home has been very well received by the tenancy in the marketplace. You know, another aspect of today's real estate is co-working. There's been a lot of talk about what's going on with co-working across the country. WeWork is going through their IPO right now. We do have co-working throughout our portfolio. It's about 3 to 4% of our tenancy. I think what's really important is when you look at co-working as a tenant is really limit the amount of tenancy that they have in each individual building as well as across a portfolio. But we do believe that it's a positive attribute for the building. We've actually had a number of large tenants that are excited by the fact that we have co-working facilities within our building, which really provides them with a release valve for space needs. If they have a special project or some growth where we can't accommodate them because the building is full, it actually allows them to move into some space on a short-term or temporary basis to accommodate those short-term growth needs that they may have. So overall, we are actually a fan of co-working, but you do have to be careful as a landlord what kind of exposure you have across your building as well as portfolio. For example, we just signed a 53,000 square feet lease with a co-working operator in our building in Legacy Town Center, which is in the Plano submarket of Dallas, Texas. You know, this has been a great, they haven't even opened yet. We've spoke to the real estate department at the co-working company, and they're actually 80% pre-leased. So there continues to be very strong tenant demand for this co-working type space. So we're pleased to have them. We think it's going to be a great amenity for the building. You know, they spend significant amount of money in their space, and we've also seen tenant growth. The tenants that have grown out of their space and into our building as direct tenants. You know, they may start in a co-working facility at 1,000, 2,000 square feet, and as they grow, you know, 5,000, 10,000 square feet, the co-working environment no longer works for them, and we've actually benefited from that as well. KBS about 10 years ago really focused on investing in secondary markets. We did a lot of research in terms of you know, the university base there, tenant demand, really the strong employment growth markets that were outside of the first tier of the gateway markets. And we've been very active investing in the Portlands, the east side of Seattle, Raleigh, Nashville, Austin, some of the smaller markets that we actually started to see strong tenant demand. So we made a concerted effort to invest in these types of markets over 10 years ago. And recently, you know, some of these markets have actually had strong institutional interest over the years, but a lot of institutional capital now is starting to flow into some of these secondary and tertiary markets. So we're starting to see, you know, great liquidity. You know, one of the things we really look at when we buy an asset is when we're ready to sell it, what type of liquidity optionality do we have? You know, if your only choice is selling to a local operator or family wealth office in that market, your pricing power on the exit is somewhat limited. You know, these markets also are providing us with almost 200 basis point yield enhancement as compared to some of these gateway markets. So I think that's why a lot of the other institutional capital is starting to flow into these markets. They're actually selling some of their larger assets in the San Franciscos and New Yorks that have very low cap rates and redeploying that capital into these secondary and tertiary markets that provide significant yield enhancements. You know, our investment outlook for 2020 continues to be positive. We've had some of the strongest leasing activity over the last 12 to 18 months across our portfolio. So we continue to see really strong tenant demand. There's significant capital on the sidelines from investors who have raised funds that have been unable to invest. So we continue to see values of real estate holding up. And again, I think the most important component of real estate today is tenant demand, and we're seeing strong tenant demand across almost all the markets that we've been investing in. Really, the key to KBS's success over the years is really sticking to our investment theses, which is buying great assets in great locations that have these urban walkable amenities. We continue to see time and time again that these types of locations continue to attract some of the best tenants in the business. The properties that we own in these types of locations have performed extremely well. We have a number of assets in downtown Portland, Salt Lake City, and some other markets where the tenant demand continues to be strong. So we're very pleased with these types of investments in these types of markets. Thank you for watching. For more information, you can actually go to kbs.com.